Ratios are an input into which step in the financial statement analysis framework. Process, collect, and analyze or interpret the processed data. Well, we can't process data until we've collected it. That is step one. Processing data turns it into a manageable set of data. And then you start to analyze, interpret it by calculating ratios. Some of this analysis and interpretation is the calculation of ratios. So it's got to be C. Which phase in the financial statement analysis framework is most likely to involve producing updated reports and recommendations? Well, you update in your follow-up. I think that's fairly obvious. This is your initial stage, and analyze and interpret and develop and communicate. After you've done that, you would follow up. I don't think that's too testing. Which of the following best describes the role of financial statement analysis? What are we doing when we analyze these financial statements? A, to provide information about a company's performance. Well, that's the role, or at least part of the role of financial statements, not the analysis. So I wouldn't say A. B, to provide information about a company's changes in financial position. Again, part of the role of the financial statements. C, to form expectations about a company's future performance and financial position. That's what analysis is all about. We're looking at C. The primary role of financial statement analysis is best described as. So we're talking financial statement analysis, providing information useful for making investment decisions. Well, that's the role of your source material, be it financial statements or whatever it may be, not the role of the analysis. B, evaluating a company for the purpose of making economic decisions. That's exactly what analysis is. I'm all about B. C, using financial reports prepared by analysts. Well, that suggests the analysis has already been done to make economic decisions. It has to be B. International financial reporting standards, IFRS if you will, are currently developed by which entity? B, the International Accounting Standards Board. That is a fact. US GAAP. So US generally accepted accounting principles are currently developed by which entity? The Securities and Exchange Commission, the SEC. We do see guidance from the SEC in these modules, where things like revenue, but they don't develop US GAAP. It is the Financial Accounting Standards Board, the FSA, that does that. A core objective of the International Organization of Securities Commissions is to, we are talking old friend IOSCO, eliminate systematic risk. Bold, it would be nice. More realistically, it's to reduce. B, protect users of financial statements. Too broad. Investors. C, ensure that markets are fair, efficient, transparent. It's C. Which of the following best describes why the notes that accompany the financial statements are required? The notes are required to permit flexibility in statement preparation? Well, no, that's not why they're there. You can have flexibility in the presentation of the income statement, etc., the way you present expenses without notes. B, they're required to standardize financial reporting across companies? No, again, the standards do that. C, provide information necessary to understand the financial statements. That's what they do. You have aggregated data in the primary financial statements and all of the backup for the sophisticated users of the accounts in the notes. The notes is where we live. Accounting policies, methods, and estimates used in preparing financial statements are most likely to be found in the auditor's report. Well, you'll see some key bits of information in the audit report, but not all of them, so certainly not every accounting policy is going to be in there. Management commentary. Management commentary will talk through critical areas of the accounts, but it's not going to list out all the policies, methods, and estimates. It's headline numbers in the commentary and trends and objectives. So it's not B either. Is it C? Notes to the financial statements. It certainly is. That's what the notes, or at least what one of the notes will give you. Information about management and director compensation is most likely to be found in the auditor's report. No, you're not going to get all of that in the auditor's report. They're giving an opinion on the accounts and on management controls, internal controls, and key risk areas, but not compensation. Proxy statement. Before your AGM, you'll get a proxy statement that will detail that information. Not in the earnings release. See if you can guess what the focus of the earnings release is. Information about a company's objective strategies and significant risks are most likely to be found in. You will not see the auditor talking about what the company's objectives and strategies are. The management commentary, exactly. They're the big hitters that the management commentary wants to cover. Notes to the financial statements, you won't see notes covering objectives and strategies. So, has to be B. Or what type of audit opinion is preferred when analysing the financial statements? You would like the financial statements to be accurate and fairly stated. And if they are, the auditor will have given an unqualified report. Qualified means there is an exception, there is an area of the accounts that they don't like. Adverse means they're all a lie. Run away. Has to be C. An auditor determines that a company's financial statements are prepared in accordance with applicable accounting standards, except with respect to inventory reporting. This exception is most likely to result in an audit opinion that is, but we can't say unqualified because then they would all be fine. If there's an exception, it's not unqualified. It's certainly qualified. It's not adverse because they've said they are prepared in accordance with applicable accounting standards, except for one area. If they were adverse, they'd say, look, they're all wrong. You can't rely on them at all. So it's got to be B. An independent audit report is most likely to provide absolute assurance. No, you can't do that. Reasonable assurance, yes. That the financial statements are fairly presented. That's what auditors are about. C, a qualified opinion. It's not most likely to give a qualified opinion. Very few opinions are qualified. That means there's an issue with respect to the transparency of the financial statements. No, it is B. Interim financial reports. So your 10Q, your quarterly, released by a company are most likely to be monthly. No, not monthly, usually quarterly, might be semi-annually, depending on your jurisdiction. Unaudited, true, they will contain unaudited financial statements. Unqualified, no, unqualified is an audit opinion and they're unaudited, so can't be C. The answer is B. Which of the following sources of information used by analysts is found outside a company's annual report? The audit report is part of the annual report. Peer company analysis isn't. That's outside. You don't get peer company analysis within the annual report. Management discussion and analysis, the MD and A, that is within the annual report. The one that is not is peer company analysis. The answer is B.